Today we're going to look at a few different formulas we can use to analyze rental properties and whether they're good deals for us or not. Now, these formulas are not absolutes, as nothing in real estate is. What I mean by that is you cannot simply decide whether a property is a good buy or not just by looking at numbers. There's so much more that goes into it. Is the structure of the home sound? Is the area forecasting strong economic growth? How is forecasted future supply in the area? Are they going to keep building homes, or is the inventory limited? However, when analyzing a bunch of different opportunities at one time, these formulas help us pit one property against another, and they help us quickly eliminate the ones that won't be profitable to us. This helps us focus in on the ones that show good potential. The other thing you really need to keep in mind is, what is your goal in real estate investing? Is it to provide you with as much cash flow as possible so you can live off the income and retire? Or are you willing to invest in a property that may appreciate more yearly and give you a solid foundation for your retirement down the line, but it might not provide that necessary cash flow that you're looking for right away? So let's talk a little bit about the different ways to approach analyzing investment properties. The first formula we're going to look at is the Gross Rent Multiplier. The Gross Rent Multiplier, or what we call the GRM, is a really solid formula to look at markets as a whole, or to compare two properties in different price ranges to see which one is a more solid investment. The formula is simply the total price of the property, or the total average price of the homes in the market, divided by the total annual rent, or the average annual rent in the market. So for example, say you're analyzing a market and find that fully updated 3-bedroom homes in Oceanside, California sell for an average price of $945,000. Those same 3 bedrooms bring in roughly $4,500 a month in rent on average, or $54,000 a year. If we divide $945,000 by $54,000 in rent, we get a GRM of 17.5. Now, say we go a little further down the coast to Encinitas and find that the average 3-bedroom sells for $1.4 million and brings in roughly $6,000 a month, or $72,000 annually in rent. That would give us a GRM of 19.4. If we use the GRN model, the lower of the two numbers is what we would call a better investment. So by using the GRM approach, we would find Oceanside to be a better investment for this property type because it has a GRM of 17.5. This can, of course, be used to pit two properties side by side as well for a more micro analysis on specific investment options. The second formula we use is the cap rate formula. This formula is used to indicate the rate that is expected to be generated on an investment property. The cap rate is a really effective way to pit a real estate investment up against other forms of investing, like a treasury bond or investing in a stock market index. Lots of investors will use this formula to see whether the return on a real estate investment outweighs that of investing in a simple treasury bond, where they have to put in no work at all. How we determine the cap rate is as follows. You take the total rents you make on a property and you subtract out your operating expenses. These are expenses like property managers, landscaping, maintenance. This doesn't include your mortgage payment, only the cost of operating the property. This gives you your net operating income, or your NOI. You then take the net operating income and you divide it by the total purchase price of the property. Here's an example. Say you purchase a property that makes $200,000 per year in total rents, but it costs about $20,000 a year to run this property. You have a net operating income of $180,000, and you can buy this property for $2.5 million. Dividing the net operating income by the purchase price, you get a cap rate of 7.2%. Index funds typically are seen as successful with a 6% return, so I would call this a good investment. The third formula we use is the cash-on-cash return formula. This formula is good for us to understand the total return we're making on our down payment investment. Typically, investors want to know how much cash they will be making on the actual cash they're putting down, not just on the purchase price of the property, of which 80% is leveraged using the bank's money. This helps us also understand just how much cash we're getting back on our property every month, so we can be more disciplined with our cash. How we get this number is by first determining the net income after financing, or the NIAF, which is simply the net operating income of the property, total rent minus expenses, minus your financing costs, or the cost of your mortgage. An example of this would be an NOI of $5,000 in total rents, minus a mortgage of $4,000, which would give us an NIAF of $1,000 a month. Now you need the annual number, so times that by 12 to get an NIAF of $12,000 annually. You then take that annual number, the NIAF, and divide it by the total amount down you put on your down payment. Say you put $100,000 down on this property. You would divide $12,000 by the $100,000 down payment to get a cash-on-cash return of 12%. So how do we use these formulas to analyze deals effectively? Well, as I said in the beginning, they're a great framework for us to understand the viability of the investment and whether it's bringing in the return on investment that makes it a good investment for us. You have to do more analysis on the back end to see the comparable sales, find out the growth prospects in the area, but these three formulas will have you well on your way to understanding the feasibility and return on any given specific property or area as a whole. Please subscribe below for more tips on real estate investing, and as always, have a great day.